So in Chapter 3, we looked at the first 4 steps of the accounting cycle. So we can now use source documents to record business transactions. We can record business transactions in a general journal, post journal entries to a ledger, and take a trial balance of the ledger. Okay. In Chapter 4, we're going to look at the next 4 steps in the accounting cycle. And those include determining needed adjustments, preparing a worksheet, preparing financial statements from a completed worksheet, and then journalizing and posting adjusting entries. So what is an adjusting entry and why do we need them? An adjusting entry is an entry made at the end of an accounting period to bring an account balance up to date. Adjusting entries are needed because it's not practical or possible to account for the change in some accounts as the change occurs. For instance, supplies. They're used on a minute-by-minute basis. People are grabbing ink pens, sticky pads, paper clips, rubber bands, etc. So it would be totally impractical to measure and record each item of supply as it's being used. How are you going to record the cost of a paper clip, right, or a rubber band? So it's difficult to measure and record daily consumption. So as a result, during the accounting period, the balance of the supplies account shows a greater value of supplies than what's actually on hand. Now, that is not a problem until the end of the accounting period when we have to do our financial statements. So, before we can prepare accurate financial statements, those accounts have to be adjusted. So, adjusting entries are needed so that we can properly state revenue, expenses, and net income, the amount of assets and liabilities, and update the owner's capital account. So, adjusting entries are updates to the balances of existing accounts and don't involve exchange with outside parties. Nothing new is acquired, nothing sold, and no revenues are earned. So, adjusting entries are referred to as internal transactions. And take note, adjusting entries never affect the cash account. Now that's a strong word, but never affect the cash account. So if you're journalizing an adjusting entry and you're thinking of journalizing cash, don't. So what accounts might we use adjusting entries for? Well, definitely supplies, like we've already talked about, expired insurance, depreciation, and unpaid wages. So at the time of purchase, supplies are a 100% asset. But every time you use supplies, there's less of that asset. So, at the end of the period, we got to take the value of supplies out of the supplies account and transfer it to the supplies expense account. And the adjusting entry for supplies always involves a debit to the supplies expense account and a credit to the supplies account.